We have a very eminent set of panelists who would be debating various issues, and thereafter, ASSOCHAM will take the views and forward that to RBI and the MPC. I think some of the points have been briefly touched in the offline discussions, which I overheard, which Sri Abhi Borwaji was stating. And I completely that's the feeling which I'm also getting down when we speak to various stakeholders. While the corporates definitely would like to see some kind of a rate cut, but the efficacy of that at this point in time, in terms of rate transmission, may not give the desired result, specifically with inflation still not being fully under control, and that too because of the looming food inflation which is happening. But other parameters look pretty good in terms of CAT deficit, etc., and the industrial production. So I think on keeping this short, I'm very eager to hear the views of all the panelists, and I warmly welcome all of them on behalf of ASSOCHAM. Over to you, Dr. Charan.
Thank you. Thank you so much. Let's go. As I mentioned, Dr. Bhalla will be joining us a little late, but we are expecting him around 3:15. So let's go to our the panel, the first panelist from ASSOCHAM, Shri Rajan Pental, who is the ASSOCHAM, who's the chairman of the ASSOCHAM National Council for Banking and executive director at Yes Bank. Mr. Rajan Pental, please.
Good afternoon. It's a pleasure to be among all. Good to see you, Dr. Charan, and also good to see Abhik. We are seeing each other after ages.
Yes, hi Rajan. Hi, how are you? Good to see you.
I'm good. From my perspective, the way things are going in, while we all expected a good ending towards this particular month and then the quarter, but as rightly being anticipated in the last 1 week or so, and as rightly being communicated by various economists, eminent economists across the country, clearly the tomato, which generally puts its mark in the May, June, July month, has shown that impact, but with a little more vigor, followed by the vegetables, and also rice has been a challenge, and India has taken a right step by stopping the export of non-basmati rice and also the cereals. So given the situation, the inflation really seems to be playing a bad spot at this point of time, and we see that Q2, Q3 seems to be moving towards that 6%, 6.5% kind of inflation. So this is one piece which clearly is now visible, and we will see it at least for the next 2 quarters playing around, and then we will see Q4 possibly seems to be a little lighter on this front. But given the inflation pressure, clearly the interest rate scenario is going to be where it is today. The chances or the anticipation or the expectation of the industry to see a cut on the CRR, to see that there would be softening of the interest rate does not seem to be in sight, at least at this point of time. That is how I would look at it. Most of the other parameters being kind of are stable at this point of time. So I think the focus has to be on these 2 parameters by and large.
Thank you so much, Mr. Pental. So your conclusion is we should not raise it, right?
Yes, absolutely.
And what are the 2 variables you had? One was, of course, the impact of tomato, rice, and vegetables on inflation, and it's showing a little tightness. By 4th quarter, things should ease out. And what was the other point?
No, largely, I think otherwise the other industrial output, etc., those parameters are absolutely stable. While we haven't seen the kind of capex, being really coming up, except only couple of sectors, which is steel, cement, etc. But I think this is what really is the focus area, which will make the interest rates not really going down, at least for the time being, for the next couple of months.
Okay, not going down. So now I would like to share the thoughts from the industry of Mr. Subhash Agrawal. You know, he has been always with us right from the inception of our shadow monetary policy. Today, he is flying from Kanpur. I don't know if he has joined. Subhash ji, I think he's
SC Agarwal hasn't joined us yet.
SC
I
Agrawal.
just yes, yes, sir hasn't joined. So
Has he
I'll
joined?
no.
He is not.
Agarwal sir
I
hasn't
knew
joined.
there was a
I'll let
flight scheduled at 2:30. I know that. So I requested him if the flight gets delayed, do join us. In any case, he has shared his thoughts with me, and I'm sharing them now because our sole purpose of doing shadow with industry is getting the industry's thoughts with us. And SC Agrawalji told me that Indian economy is doing well, exactly as Mr. Pentel mentioned. And he said the industry is also very stable and doing reasonably well. And according to him, the economy per se, globally, India's position is strong, and Indian economy is the fastest growing economy in the world. Therefore, he thinks pause should continue and there should be no disturbance to the repo rate. This is the view of SC Agarwal from ASSOCHAM, the industry expert. With that, now we go to the EGROW experts, and I would now like to then invite Indraneel Gupta, who's head of research, CLSA India. Indraneel.
Yeah, thank you, Dr. Singh. So we are looking at a pause this time. Our call is that the RBI can cut from December 100 basis points if the Fed pauses at 5.5%. If the Fed were to go to 5.75%, then we think the RBI will have to hike 25 basis points and maybe cut 125 basis points from February. As it is, the differential between the RBI and the Fed has now narrowed to just 100 basis points. And once you adjust for swap rates, clearly, it's far more attractive to be in the dollar. As far as the rains go, we are obviously seeing inflationary pressures from uneven rains, and so that is one fact. The rice belt seems to be set up for a double drought, so there will be inflationary pressures for the time being. At the same time, because you have good rains in the north, the next crop is expected to be a bumper wheat crop and so on. So I think that the inflationary pressures will be temporary. Therefore, I expect the RBI to look through these inflationary pressures. I think it's only if the Fed raises, the RBI will raise, and then they will say that, okay, there are domestic inflationary pressures as well. But otherwise, I think that the RBI will look through whatever is happening on the food side for now. So I think the main driver still remains the Fed, and growth, in my view, is going to slow down. We are looking at a 5.5% growth for the year, which I think is below consensus. Because when you have real lending rates going up the way they are, real lending rates, I think, are up some 1,000 basis points adjusted for WPI over the last one odd year. The fact that the RBI had linked rates on priority sector to the repo rate has meant that the priority sector is seeing a 250 basis point increase in nominal rates versus 125 basis points for the overall. So the vulnerable sections are actually ending up hurting more right now. There's obviously a slowdown in export demand, and now the rice crop is not going to be anywhere close to normal. So we think that the RBI will therefore obviously want to cut as soon as they can, but the least that must happen is that the Fed has to be conclusively done for the swap rates to turn and for the RBI to be able to cut without sacrificing the rupee. So that's our call. Pause this time round, and then either a cut in December with the Fed at 5.5%, or a hike by October, and then a cut of 125 basis points if the Fed goes to 5.75%.
Indranil, thank you so much. Just for the sake of our listeners, would you like to clarify what did you mean by a double drought in rice?
So the entire rice belt had very poor rains last year, and the rice crop was, I think, 7.5% lower. And this year, again, at least till a couple of days back, all the states in the rice belt are running at deficits of 20 to 30, even 40%, which means that this year's rice harvest is also going to be pretty weak. So you are seeing, for farmers that grow rice, 2 years of very poor income.
Right. So thank you so much. Let's go over now to my friend Abhi.
Yeah, hi. Thanks, Charan, and thanks everyone for dialing in. I don't think I have much to add to what the previous panelists had to say in terms of the expectations around inflation, particularly the pressures emerging on food inflation. I'd just like to mention that global factors are also somewhat adverse, in the sense that you have a problem with sunflower exports from Ukraine. You have a problem with soybean from the US because of extreme heat. You have an enduring problem with wheat because of the Black Sea trade effectively being completely clogged up. So the global situation in terms of food is also kind of is not looking good, and that kind of adds to the RBI's problems. And I think one can look through things like vegetable prices, but if you have an increase in rice and pulses prices, that's another pressure point, especially tur. Then you tend to get into kind of a sticky food inflation situation. And one must recognize the fact that inflation expectations are very heavily leveraged on food prices. So that's a concern. But that said, I don't see a reason for a hike immediately. I think one positive thing that we need to take note of is the fact that core inflation has been coming down, and one could expect some kind of a downward trajectory. Also, globally, inflation, particularly the US, is coming down. So, to Indranil's point that it has to be contingent on the Fed, we can kind of put a higher probability on the Fed staying pat rather than it moving. I just wanted to make a sense. We are, at an industry association affiliated on an industry association affiliated platform. Let me just talk a little bit about credit dispersal and what is going on there, and rates and so forth. While I take Indranil's point that aligning interest rates with external benchmarks has kind of led to perhaps more than desirable transmission. I don't think that's entirely the case, especially with the corporate sector. And as one of the largest lenders, what we see is twin pressure, on the one hand to raise deposits at higher rates, but on the other hand, not being able to pass through these rates on to borrowers. And that is because of extreme competition. And also, even on externally benchmarked loans, what you can do is sort of reduce the spread or play around with the spread, so that the loan rate actually remains the same. What is encouraging, and I think this is something that we need to take note of, is that the dispersal to really what I would call the catchment of ASSOCHAM to larger SMEs, the mid-sized companies, that has increased quite considerably, and also to the smaller ones, because I think there's been formalization to the pace of formalization has picked up. It's also because of partly because of GST, partly because of the Udyam portal and so forth. So we see a lot of traction there, including what is unusual is in certain cases we see the medium and small size companies actually lead the capex cycle, and indeed we see that in the case of things like auto ancillaries and so forth. And so I think the funding situation, both in terms of cost and availability, for not only the large corporates, but the segment of corporates that ASSOCHAM it tends to be focus on, and where ASSOCHAM very actively partners is kind of reasonably comfortable in terms of the funding situation. And formal funding, I think, is getting a fillip because of the formalization process, and that's intensifying by the day, which is, I think, good news, and that's something I just wanted to flag in this meeting. So I would say, in terms of the policy action, hold, and in terms of the stance, stick to withdrawal of accommodation, because removing it has many implications which are disruptive. And I think it'll have to be a wait and watch strategy, or data dependence, whatever you want to call it. And let's see what happens going forward, both to headline inflation as well as to global developments, including what the Fed does. Thank you.
Thank you, Abhi. I must mention, for the benefit of listeners, that Abhi is the Chief Economist and Executive VP, HDFC Bank. Now, Mr. Indranil mentioned about the slowdown in the economy, and IMF has just released their data for Indian economy at 6.1%, and Indranil mentioned in the range of about 5.5%. That's really quite a bit. And Abhi, what I understand from you again is that the situation is bleak. In case we look at rice and pulses, inflation should be shooting up. And the three items that you mentioned, I thought were also very important: sunflower, soybean, and then the wheat. So given that,
yes, and there is also, again, to so let me just tell you what the markets are forecasting. And Siddhartha Indranil, correct me if I'm wrong. The forecast for July inflation, which is due just a couple of days after the policy, and I'm sure the RBI will have some handle on it, is likely to be in the range of 6.4 to 6.5%. It could be due to this transitory vegetable price buildup, but it's an ugly number, and optically, for a central bank that has missed the target for a very large chunk of time, it's not something that it can be comfortable with. So that's the kind of inflation shoot up that is likely, and that automatically changes the trajectory of inflation. So I think the average inflation number will also have to be revised upwards.
And would you also be thinking of the year closing around 5.5 growth?
No, I think we are much higher than that. And I mentioned some of these things, that we do see the beginnings of a capex cycle, which is actually more comprehensive than what we had anticipated. I think, as I said, the medium-sized companies are also investing, which is good news. So I would, we are slightly on the higher side, and we are putting a number of 6.2 to 6.4%, despite whatever headwinds there are. So I don't think the situation is bleak in terms of growth. It's kind of a little alarming in terms of inflation, which is, that's where we stand.
The IMF put the growth figure at 6 for 2023, but then that's the calendar year, and we generate
Yes, yes.
No,
But
fine.
things are so uncertain that maybe Indranil will go right, or the IMF will go wrong. We don't know. Things are still very volatile, and I don't think we have any stability of of data flow or directional stability of data flow as yet, except maybe for growth, we are seeing more or less consistent numbers, which point to higher growth expectations than earlier.
Let me see if Upasna has joined. Upasna. If she hasn't joined, she has shared her thoughts, but I'll wait till about 3:15 or so because I know she is in a presentation right away. In the meantime, can I request Shri Siddharth Sanyal, Chief Economist and Head of Research, Bandhan Bank? Siddharth.
Sure. Thank you very much, sir, for this particular opportunity. We always look forward to this. And yes, I think in terms of the expectation around policy action, there's a lot of convergence at this moment that even though there is a clear expectation of very significant uptick in the upcoming inflation number, and indeed, as Abhik mentioned, we see that this inflation number for that we are focusing at this moment is indeed around 6.6% for the upcoming print, which will be due next week. Now, there's a big departure from the average about 4.5% odd in the previous quarter. The big question is whether this is a beginning of a different trajectory or a different gear for a significantly long period of time, or this is maximum up to just about 2 to 3 months. At this moment, given that the big contribution, even though, I mean, as I said, that from 4.8% in the previous print, our forecast for inflation in this particular month is going to 6.6%. From about low 5% of core inflation number, we are projecting something like 5.8% core inflation in this particular print. But we are still inclined to believe that this particular spike in inflation is for about a couple of months or maybe for this particular quarter and not beyond that. The reason being that a large, significantly, overwhelmingly large proportion of this particular spike of this 180 basis point journey is coming still from food prices, etc. Now, we all know that there is all the time there are not only media headlines but I mean media headlines and all the discussion about the rising vegetable prices and near-term weather disruptions that we have seen, and because of that, how some of the vegetable prices is changing the trajectory of inflation in the near term. But typically, if it is confined only to that, we get to see that it spikes very rapidly and then cools off within also 2, 3, 4 months as soon as a new chunk of crop comes to the market. So the key question is whether this food price inflation will be confined mostly to vegetables and perishables, or there will be more stickier items like cereals, rice in particular, or also some of the edible oil related pressures which we are seeing of late coming back a bit again. So we have to see the numbers as when it comes. But if broadly that is what plays out at this juncture, very clearly, just because it's at this moment not a sustained big spike as of now, there is a clear possibility that the numbers might look different, say 3 months down the line. The expectation from the central bank and the MPC is clearly that of wait and watch. They have covered a very significant ground over the course of the last one year or 1 year, 1 quarter. So they can afford to stay on a bit of a wait and watch mode at this juncture very clearly. Completely agree with Abhik as when he mentioned that we should not rush in terms of changing the stance of policy also, because that's potentially disruptive in terms of disanchoring in terms can be a bit disruptive in terms of expectations and interpretations of the stance of policy. So we stay on hold on both on those two fronts. Now, what is in store? Let us, if we go one by one, if we turn out to be correct on August 10, what is in store on 8th of October? I think that's also a very pertinent question at this juncture. I think it will be dependent on 2 to 3 factors. One is obviously By the time we'll see 2 inflation prints for July as well as in August, and also we'll have a decent sense about what is the next inflation print and what is the trajectory after that. I think if we our bias is still to think that at that point of time, on a forward-looking basis, in the beginning of October, we'll possibly have an expectation of inflation scenario improving from that point onwards. Number one. Number two, a key joker in the pack obviously is what Fed does towards the end of September, whether they hike or not. If the Fed decides not to hike on that particular day, the pressure on RBI on 8th of October is significantly less. And the last other factor I would like to very clearly mention, which apart from what has been mentioned earlier also, that around that point of time, what the currency is doing, what the INR is doing, even though the RBI doesn't speak about that explicitly, that openly, very clearly that possibly plays some kind of a role in their decision-making process around that time. The same 6 persons on the Monetary Policy Committee can afford to take a slightly bigger risk in terms of going for further wait and watch if the currency moves more or less sideways or stays broadly anchored. And if the currency starts showing a little bit of vulnerability, then the margin of error for the monetary policy at that point of time is relatively less. So I think these 2-3 factors will possibly play a very significant role. And in terms of our expectation, we do think our bias at this moment is to think that at that point of time we'll have a slightly positive outlook, future outlook for inflation at that point of time. We are relatively less sure what exactly the Fed is going to do around that time. And our bias is to inclination is to believe that currency will broadly be not too disturbing at that point in time. So our inclination is more towards thinking about that the pause continues, but we'll have to really see what is in store maybe another month and a half down the line, and then can take a view. But just wrapping up on this week's next week's policy, we do think that there is enough reason to stay on hold, show a little bit of patience, and if at all there is any need triggered by any of the 3 factors, it's a call another 2 months down the line. We spoke about the inflation numbers. There's a little bit of interesting discussion in somewhat different directions from Indranil and Ovik. I think the way we are seeing it, we were clearly seeing a bit of an uptick till the month of June in terms of some of the activity indicators, apart from just what we see in terms of hard numbers. Even in terms of the touch and feel of the customer base, we were seeing a lot of a bit of at least improvement till about that point of time. With the significant weather disruptions in various places, there has been an obvious disruption in that momentum in the month of July at this moment. Here, in terms of our interpretation, that's why we are also on a little bit of a wait and watch mode in terms of firming up of our views on that particular aspect, whether in another 15 days time we see that particular momentum in terms of consumer sentiment or borrower sentiment, we get to see that coming back relatively quickly, or that becomes more entrenched. I think that's very significant, and possibly another 15-20 days time, hopefully, unless there is any fresh round of disruption, we might have a better answer, and hopefully the answer is a better one. So that's where we stand, and we'll stop here, and happy to take questions later on.
Siddharth, quick question. Siddharth, good question. Thanks for this analysis. Do you see any stress in the banking portfolio, or at least at the end where your bank is? Do you see? And of course, I'm going to ask the same question towards the end if all the speakers don't come, to even Mr. Abhik Barua, because he's also from the bank. So do you see any stress levels and the twin deficit problem, or everybody is saying everything is absolutely perfect?
No, I don't think we see that. I mean, a stress level or pressure on the portfolio quality increasing meaningfully and on a sustained basis for this particular any meaningful change in the last 1.5 months, 2 months, I don't really see that is the case. One particular segment that we deal with reacts adversely if there is even a temporary disruption, but that disruption is also very, very temporary in nature, typically confined within a month, month and a half, and not beyond that. And that's why I mentioned about the time period of till about another 15, 20 days, 1 month, how exactly we see that particular thing coming. One particular lesson had been there for a lot of borrowers as well as for banks and our risk department also, that they are trying to be slightly more forward looking in terms of assessing what risk is waiting for them in the very near term also, apart from big large macro risk. And I think their degree of preparedness typically even for some of the potential disruption, say even weather disruption and things like that, is slightly more granular, and as a result we possibly are getting into this kind of situation better prepared. So that way I don't see really a stress, but just someone picks up health parameters of the portfolio for the month of June and month of July. Obviously June was a better one.
Thank you, Siddharth. Let's go on to Mr. Arjun Nagarajan. He is the Chief Economist and Communications Manager, Sundaram Asset Management Company. Arjun Nagarajan, please.
Thanks a lot, Prof. Thanks a lot, everybody. Thanks for joining in. I'll just keep it quite quick. I think everybody sort of covered all the key points that have to be said. So from a policy point of view, continue to expect the RBI's narrative to remain hawkish in its upcoming policy. The stress here is the narrative. However, the key drivers for the RBI or any moves on the policy rate, we continue to feel it will just be two. One, the Fed, and second, India's trade deficit. So we see the Fed to have sort of peaked on their rates and therefore do not expect any more Fed rate hikes for the rest of the year. We feel like Fed will continue on these rates all the way till Feb of next year. Rate cuts from the Fed will only be somewhere around March of 2024. That's our base case. As a result of that, we feel the RBI will also be on a hold, an extended hold all through FY24. The first rate cut from the RBI, we're expecting it only in the June quarter of 2024. On rate hikes, the risk of any more rate hikes, if the Federal Reserve does another 25 basis points rate hike, then I think that's the only case we see where the RBI would hike rates outside of these policies. Now, on the current inflation numbers, I think there's a fair bit of inflation. So tomatoes are at 200% plus year on year, pulses are at 40% plus year on year. So expect the RBI to sort of see through this, though there will be some commentary on the supply side measures and how the government probably should possibly step in. But I think from a narrative point of view, I think they'll possibly look at this as a one-off and then wait for a few more months to really add any commentary on that. So long commentary short, I think pause in the upcoming policy. The focus will continue to remain the trade deficit and the Fed from an RBI point of view. I think I'll stop there.
Arjun, do you think there's because you're from the asset management company, are you seeing or expecting any stress on the assets?
No, not at all. So macro parameters, I think everything's doing fairly fine. Even our parent company on CVs, I think the outlook that we seem to understand is fairly positive as well. So no weak links, at least from a narrative point of view, that we are hearing.
Thank you. I just want to check once again if Upasana has joined. Upasana? Okay. If she has not joined.
Mr. Charan, if you permit me, I would like to comment on the question which you have been asking. The two.
I will come back to you and Abhi on the same question. So I'll just finish one round. And then I just want to check if Upasana is here. I think she is not yet joined. So what I'm going to do, I'm going to read what she has sent me And in case Karthik, you notice she joins, we'll give her an opportunity to speak in person. But just let me summarize what she has written to me now. She says the cumulative impact of more aggressive Fed rate hikes and persistent upside risk to domestic inflation could prompt a 25 basis point rate hike. But I firmly believe that a prolonged pause is a better policy choice than swings. So my reading of Upasana, and if she joins, she'll clarify herself. My reading of Upasana's is that she's also saying there is pressure from the Fed and inflation, but she prefers pause. Let me come to you with my thoughts now, and I'll be a little more detailed because I know we have listeners from different places. And after my presentation, we will go to Dr. Surjit Bhalla if he has joined by then. Otherwise, I have his written comments. I'll read from there. So my own reading is that the economy is doing well. We have just had excellent data on GST collections. It is 1.6 lakh crore in July, which is about 11% higher than July 22, which means the economy is doing very good at that level. As far as the ITRs are concerned, very encouraging figures till end of July. 6.8 crore filings have taken place, which is 16.1% higher than 5.8 last year. The first time filings are 53.7 lakh until July 31. So I think the fiscal picture is also going to be very good as far as the government is concerned. When it comes to banking deposits, and that's what I was trying to understand, the data which I have been able to collect shows that the deposit growth in the current year is around 9.3%, 22-23 year just closed. And that is compared to 8.2% in the previous year. But when it comes to advances, it's around 15.8 and 9.8 previous year. So overall trend in the banking industries, I think they're getting good amount of deposits and advances are taking place. As far as the industry is concerned, and I see a couple of views have already been expressed, but let me reiterate that IIP is around 5.2% for the month of May. I thought that was interesting. And if we look at the use-based industrial production, again, I thought there are sectors which economy is doing reasonably well. I wouldn't say it is booming, but if you look at consumer non-durables, doing well. If you look at infrastructure, doing well. And if you look at the 8 core industries, in the 8 core industries, again, I thought there was some positive sign on fertilizers. I know, as Indranil explained in detail, the twin drought story, I thought that's very analytical. But then if I look at the fertilizers data, shows that in the 8 core industries, there's good performance of fertilizers. Also, there's good amount of performance in steel and cement. And that probably reflects what's happening on the infrastructure. External sector has been discussed partially, and the discussion has been on the rupee. But if we look at the trade deficit in the first quarter, April-June 22, compared to April-June 2023, the trade deficit is down, which is, I think, a positive thing, from $31.5 billion to $22.59 billion. So on the trade, at least on the trade deficit, I think we're doing well. I was also worried about the exports, but then I was looking on the quarter-over-quarter performance of exports. I totally agree there is so much more to it, but electronic goods did about 47.1% better than the previous year, previous quarter of the previous year, and iron ore about 35% in the current year quarter over the previous year, similar quarter. So exports to that, I was worried myself that growth is so badly impacted in the rest of the world. As far as prices are concerned, everybody has shared their thoughts, and the data on prices that we have is for June. But we all know that tomato misbehaved in July and so on. And WPI, of course, is in the negative zone for both food and all commodities. So there is space, I would say, there. And when it comes to CPI, I won't say there's much space, has already been expressed, especially by Abhi. For all commodities on CPI, in June, the inflation is around 4.8. On food, it's 4.49. So as it is, we are above the average, and I see very little very little space there. It could just blow up in case all the things that have been mentioned, especially by Abhi here, on things like tomatoes and rice and pulses, things could become bad, and then the pressure mounts on the RBI. If we look at inflation in other countries, which means the pressure for them to raise their rates is now almost mitigated and going down from the high rise of 9 to 10% of inflation. In the US, it's back to around 3. In UK, it's around 7. And so the pressure is getting abated there. That is something good. As far as growth is concerned, yes, growth continues to be a concern everywhere. And I think Germany has come in the bad zone now, and that is worrisome. And even for next year, the projections for Germany are little worrisome. So inflation is under control in the rest of the world to some extent. Growth is worrisome, Germany especially a concern. And if we look at the crude is tightening, it seems, and I'm not very sure why. And so is the gold tightening. Gold tightening always gives me a fear that there is some uncertainty somewhere, and that's why it's tightening. As far as the policy rates are concerned, Canada, US, UK, Euro, they have raised it by 25 basis points. EMEs, I don't think, have raised it in the recent 1 month. So that is the picture that I have while I was analyzing, that I have in my mind. With this picture, I would continue to believe that the economy is doing reasonably well, and therefore disrupting in any way anything, either the stance or the repo rate, may not be the right strategy. I will go with my team, which says in case there is pressure on ours by America raising its policy rate, we may have to match it. And I think, as Indranil mentioned very clearly, 100 basis point is the gap now, and anything getting stretched beyond that or getting impacted by that, India may have to react. So I think that is the point, which is very valid, and I would go with that. So my own view is hold on to the position, don't change anything and don't disrupt anything. Economy is in a good saddle, and let it just continue the way it is going. Those are my views. I would now like to invite Dr. Sujit Bhalla, if he has joined. Bhalla, sir? No, he has not joined.
Sujit sir hasn't joined, and Upasana
Not joined?
also hasn't
Okay.
joined.
Fine, because he told me by 3:15 he'll try his best to join, and it's already 3:16. So let me then just share his summarize his thoughts that he has shared with me. He says there is no evidence that inflation is rising. Rather, it is falling. It could be increasing, but there is space there. How long should we continue with the pause? His own view is similar to Indranil's, and he says when the rate cut, if the US raises it, then one can see, and this probably could be the last rate hike of the US in this cycle, and if that be, then India's pause rate should continue. Over and above the pause, then he questions when the rate cut should happen. According to him, this should not happen immediately and will not happen immediately, but he thinks we need to start thinking of the rate cut, and maybe as early as October we could, or maybe we'll have to wait a little bit longer, but we need to start thinking of the rate cut now. That is the viewpoint of Sujit Bhalla, and if he even joins, we will request him to share his thoughts personally. With that, we have covered one round of observations from each of the panelists. I would now like to come back to Mr. Pantel and Mr. Abhi Brewer in case they want to share their thoughts on any stress that they notice on the banking assets or any liquidity issues that they think. Because I always wonder the monetary policy, if there are other issues emerging, could be doing something with CRR. So trying to understand that part. Mr. Pentel, would you like to go first?
Yeah. So on the liquidity side, I don't see there seems to be any stress. You spoke about the good momentum on the deposits. In fact, the momentum on deposits is really good, and you have seen that, at least, the overall banking sector is hovering around 10%, which is actually getting led by the private sector banks, which are in the range of 16 to 17%. So I don't think deposit growth is that of a concern. The concern is actually on the pricing, and then the passing on the deposit pricing on to the lending pricing. Even lending is trending well at some 15-16%. So that also is going stable. There have been word of caution from the regulator, and there has been an observation by the bureau results also, which they share with all the banks. I think clearly there are one or two segments which one needs to be cognizant of, and it is a good time to rather make some corrections. So particularly when the growth is led by the retail and the MSME sector, as some of the other eminent panelists also stated. What really needs to be restrained is the irrational exuberance which might, emerge during the growth phase. So the unsecured and the credit card and the lower end of, the MSME clearly need to be watchful, though they are behaving very, very well at this point of time. There doesn't seem to be really a concern. But if one dissect and goes closer at the industry level, and because the bureau records are more, mixed between the banks and the NBFC, there is definitely, some steps which need to be taken at a time when the things are going too well. So you have seen, if we look at the data, the credit card sourcing across the industry, actually, each player seems to have, cut it by 10 to 15%. And this is largely not on the potential to source more, but rather on the proactive measures they have taken to cut some of the marginal profiles. So otherwise, as of now, the portfolios are doing very well, both on deposit as well as on the lending side. But a good time to pause and take a closer look to be clear, to see that there are no bubbles getting created within the portfolio. They could be really hidden at this point of time. So this is one. Two is at an industry level, if you see on the deposits, while the overall growth looks very, very healthy, but the costlier deposits, which is more in terms of TD, and whenever there is a gap between the saving account rate and the fixed deposits, obviously the momentum money is always from saving to the deposits, to the term deposits. So that movement is obviously visible across the industry, and this will be there for some time to stay. This is not going to grow because I think deposits without being much in hand in terms of the color of the money is going to continue for some time, wherein you will see the CASA overall either marginally coming down or at best being stable but no growth, and the term deposits growing much faster, which means that the rate pressure on lending, which anyway the banks have not been able to actually transfer to the customers, have not happened. The third thing is that there is also going to be some further transmission of rates. So whenever these deposits come for maturity, and as such there has been a hike in the deposit rates, so that transmission of 30 to 40 basis point will anyway happen in the next 1 or 2 quarters on the term deposit. So this is from the landscape of how the deposits and liabilities are going to go. And also as I mentioned, when the things are going very well and we all are seeing one of the best portfolio health, also time to take a pause and look at is there any bubble getting created within, or wherever people have gone in for new to credit segments, or wherever there are marginal credits being purchased, especially the short term loans. I think one needs to really be carefully looking at that.
Thank you. I don't know if Abhi could join. He was having problems with his internet. Abhi, have you joined? I think he has not joined. That's okay. Now we have about 7 minutes left. If any one of the panelists want to share an additional thought, most welcome. Siddharth, Arjun, Indraneel. And Karthik, if you notice Dr. Bhalla or Madam Upasana, just alert me.
Sure, sir.
Sure.
But we are not here as of yet.
Yeah, that's okay. Siddharth, Indraneel, do you have any thoughts to share? Anything more? Arjun?
Nothing incremental from my side, Mr. Doctor.
Okay. Siddharth?
Nothing very specific, sir. In case if there is some interesting question from the audience, we can quickly check.
Sure. Indraneel? So let me open it to the audience. Any questions for the panelists, please?
Sir, this is Gautam.
Right.
Am I audible, sir? My question
Yes,
is
you are.
my question is for Rajan sir, our ED sir, that GDP in our country, India, is close to 3.5 to 3.6 trillion, if I'm not wrong. So, what is his outlook that where we should reach on March 24?
Well, the global growth projection is 6.1% growth, and I would say around that. But Mr. Pentel, would you like to take this question?
Sir, I would rather look at it being at a slightly higher level from here, and proceeding towards the levels which we spoke about in your when you were speaking, more in lines of moving on that direction.
All right.
Okay.
Any other question, please? Or anyone has any other question?
Dr. Charan Singh, this is Madhav here, if you permit.
Yeah, please, Madhav.
Sir, I think one of the speakers did mention that there has been some private sector capex being seen. So, a couple of questions: which sectors, and is it on brownfield or greenfield?
One of the persons who spoke on the capex was Mr. Pentel himself. And so let's first hear from Pentel, and then I'll open it to the panelists. Mr. Pentel, do you have a view on capex?
So capex is largely seen more on the brown projects rather than the green projects, while there are opportunities emerging, but the pace, and I did mention that the largest sector where we are seeing is infra, steel, cement, and it is yet to actually get across the sectors, and that is not in I mean, the pace of growth, there is a lot of difference between the sectors which I spoke about and the other sectors. So it has to get more diversified for the real demand to come from all the sectors.
Anyone amongst the panelists want to take this question? Indraneel, Siddharth, Arjun?
Doctor, just one small bit. So we were just looking at some data for FY23. So if you look at government capex, central government capex for FY23, they've largely been led by renewables, roads, and railways. And if you look at the state capex for FY23, large focus on roads.
Mm-hmm. So basically, the infrastructure which Mr. Pentel was referring to. Sure.
Yes.
Siddharth, Indraneel, on the capex cycle.
No, so we are fairly bearish on capex,
Okay.
private capex. We are not seeing any private capex come up till the next, 2-3 years. But I think Avik was making that point. I don't know whether he's on the call.
Abhik had problem with his internet. He has
Okay,
left
so
a
it was
message.
Avik, I think, also who was saying that.
Yeah.
But we are very, very negative on private
Right.
capex immediately happening.
So even from our side, the view is possibly more in line with what Indranil is mentioning. So there are 2 points. One is in terms of overall capacity utilization, it's still not very strong, just some moderate improvement in that. And if we do actually think that the softening in interest rate from here on and the high real interest rate can actually stay there, and the softening in real interest rate, our assumption is relatively much more moderate. In terms of the repo rate moderation from here on, our view is it's a moderate path of moderation going ahead in FY 25 and nothing at all in FY 24. So we think that capex recovery, private capex recovery is slow. And whatever growth recovery we are talking about is based on more some of the near-term factors rather than very significant uptick in the capex side.
All right. So I have requested Avik if he responds on his phone, I'll share with you. We have a minute more, and if anyone has another pressing question.
Charan sir, we have a question in the chat box from Mr. Vivian Massoft.
Can you read it?
Yeah, so he is asking, what are your views on RBI's significant interventions on forex markets to stabilize the INR? He is also saying that it seems that it currently largely reduces RBI policy sensitivity to potential further Fed tightening.
Does any one of the members want to react?
So I think that the RBI has about $25 billion of FX reserves, including forwards, and there's about $30 billion at least of Russian, oil payments that have been made in rupees, which you have to adjust. So RBI's FX is about 600 billion, which is, pretty much where we think it's adequate. So I'm sure that from these levels, the RBI will probably not want to sell FX reserves in this uncertain world to the extent they can, because clearly, then again you go down that path and then you'll have to recoup FX reserves. So therefore I think that if the Fed were to hike again, the RBI, and not just the RBI, every emerging market central bank will have very little choice but to act.
All right. With that, I think we have had an interesting discussion and very, very informative discussion. So let me then request that we go ahead with the concluding part. And I think to conclude, we have Shri Vasudev Mukherjee, the ASG ASSOCHAM, to speak to us.
Thank you. It's been a very engaging discussion indeed, and there are many takeaways from this. We will, of course, be preparing our submission to the RBI on the credit policy, on the monetary policy, and we will be taking your views into account. Our team has been making copious notes of this session, and we will compile them into a submission to the RBI, and we will put forward our recommendation. So on behalf of ASSOCHAM, I'd just like to thank all the participants and all the panelists who have joined us, and we look forward to having you again for the next session of the Shadow Monetary Policy Group. Thank you.
Thank you.
Thank you.
Thank
you.
Thank you, sir. Thank you.